would like to start by welcoming each one of you to this session on fixed income. It is my pleasure to now introduce our speakers for today's session. Mr. Debashis Basu is the founder trustee of Moneylife Foundation and the editor and publisher of Moneylife magazine. Mr. Basu is a chartered accountant by qualification with 29 years of experience as a journalist. He has worked with most of India's leading publications such as the Times of India, Business World, Financial Express, Business India, Business Today, and has written columns for Business Standard and the Economic Times. With these few words, I would request Mr. Debashis Basu to please begin the session.
Well, let's start with an interesting quote. More money has been lost reaching for yield than at the point of a gun. What does this mean? Yield, of course, here means interest rate. So the fact is that all of us look for that 1% extra, 1.5% extra, even a 0.25% extra. And in trying to reach that little bit of extra money on a fixed income product, sometimes even the principal is lost, or substantial part of the principal is lost. This is a story not just in India, and as you can see, the quote is from an international quote, but the story is across the world. The reason, of course, has nothing to do only with fixed income. It happens everywhere. But why is it so telling in case of fixed income? It's because of the simple word fixed income. You think you got it all right, it's fixed, capital can't go down, and you only want that 0.25% more, right? So what can go wrong? And therefore you take your eyes from the possible risk of the principal itself. When we do a program on equity mutual fund, I don't think we get about 100, 150 registration. We managed to get a tremendous amount of response, and the hall is already full, and people normally come late and you'll see many people streaming in. The reason for this is very simple. We all invest in fixed income first. Whether we invest in anything else or not, on an average, an individual saver has a large component of his money or her money invested in fixed income. Unfortunately, a lot of it happens by default. The way a typical salaried employee's money flows is that there is an X amount of money which is coming in every month from salary. He withdraws for his expenses, banks take away some EMI, and the rest remains in savings account. After it builds up to a point, he suddenly realizes, well, that savings account itself is fixed income. It gets you 4% on usually, and in some cases banks pay you even higher than that. So that itself is fixed income, happening by default, by doing nothing, by being lazy. After a point, the money builds up to a certain level, and you say, hey, I have so much of money lying in savings account. That's not correct. You pull it out, and where do you put? In a bank FD. So you move to a higher yield kind of situation, but you're still in fixed income. That's it. That's what the average saver usually does. The smarter ones would still remain within the ambit of fixed income and try to go beyond bank FDs, and Raj is going to go into the individual products of each of various kinds of fixed FDs, fixed income products that are there in the market, the risks, the returns, the possibilities. I'll give a broader overview, and I will try to make you aware of the pitfalls of what you think is fixed is not actually fixed, where the principle goes wrong based on the quote that I just described. Well, first of all, fixed, as I said, does not mean guaranteed. Most of us look for a guarantee in life. That's how human mind, that's how neurobiologically we are conditioned. We hate uncertainty. We hate risk. So human beings by nature look for certainty, look for guarantee, something that is safe, something that will not create a nasty surprise in future. Unfortunately, fixed income does not give you, in many occasions, in most cases, does not give you the guarantee beyond just 2 or 3 basic products. So I'm going to discuss the risk and returns of various kinds of fixed income products. Secondly, and this is a little more technical, we'll go a little deeper in this, even assuming that you've understood fully well which fixed income product to buy, you still have to deal with a very, very difficult area. And that is an area, why we say difficult, because there is very little advice, there is very little support or research that is currently available. In fact, we do research across the entire financial sector, whether it's insurance, whether it's mutual funds, stocks, fixed income, annuity, everything. We just love to go deeper and deeper into each of these products. And we realize that the savers, the people like you and me, are not usually not given a very, very critical piece of information or advice, which is how much. So even if I tell you that suppose you have 50 lakhs of savings and you need to put, let's say, some amount of money in fixed income, that doesn't solve your problem. It creates a problem for you, because when you practically try to invest, you will wonder how much of this should be in fixed income and how much should be in equity mutual funds or gold or whatever, which goes by a big term in the financial sector called asset allocation. Forget about big terms like asset allocation. In practical terms, we need to know where to place fixed income in our overall portfolio, how much to actually invest. And I have some ideas based on your profile, given your age, given your dependent status, how much to invest in fixed income. And that is going to be a very important part of my presentation, because that I don't find that available elsewhere. Now, what I mentioned about you or me and our behavior, why by default we put so much of money in fixed income, is wonderfully captured by a macro picture. As you know, as you can see from here, this is sourced from Reserve Bank of India. Huge amount of our income, whether of our savings, whether it was in 1991 in the first case or 2010-11 in the second case, huge amounts have actually gone into bank deposits. That's 39%. 20 years ago, 20 years later, after Sensex has become 20 times over 20 years, and after in 96 insurance companies have come and we now have hundreds of insurance products, 45%, which means a higher figure of household savings are still in bank deposits. And the reason for this is very, very simple, and that I explained earlier. It's not a matter of choice, it's a lack of choice. We put our money in banks and it stays there, and that's why it's all in bank deposits. Now, in search of higher yield, to go back to the first quote, we are constantly looking for somebody. Bank gives only 8.75%. This fellow is giving me 11%, all right? Or somebody is giving me 10%. So we fall for it. We want higher yield, all right? And companies like, whether it's Sahara or chit funds or multi-level marketing schemes or chain money schemes, in whichever view you describe it, they are constantly on the prowl across the country. Some are popular, some are less popular, some are very well known and large, like a QNet or Sahara or Sharada scam in Calcutta or Rose Valley and so on. Or some of them are smaller, you may not have heard of the name, but they are constantly essentially offering you a guaranteed higher yield of return on your fixed income. So they are making two promises. One is your principal is safe with us, and number two, don't put your money in bank and get only about 8.5 or 9%. We are going to give you much more money than this. And they are able to take advantage of this only because of us, because we are not satisfied and we have not estimated the risks and returns involved in what we are getting. Now, this has gone on for decades. Every decade or every 5 years, there has been a major scam. It's very hard to get, to get people to donate to a good cause. But even 15 years ago in Chennai, a company we barely know of managed to raise 1,100 crores. 1,100 crores just like that, because they promised something like this. And this has been going on for years and years and years. Eventually, after the Speak Asia scam, which became really big, Stock Guru, Speak Asia, QNet, all of these things have eventually woken up the government of India. There is already an act, Price Chits and Money Circulation Banning Act of 1978, under which these companies could have been caught and our money would have been safer. But that is a state act, which means every state individually has to act on it. Some of the states also have their own act, like Maharashtra Depositors Act MID or something, Maharashtra Protection of Deposits, or there's some similar act in Andhra Pradesh and so on, but the states don't act. Or they act when it's too late, when everybody has known about it, everybody has put in money into it, and the money is actually gone. And the promoter never really had the desire to return the money to you, so he's blown it off, taken it abroad, doesn't matter, he doesn't care, and you don't get back the money. So in 2013, the government considered all this and empowered SEBI as an organization. I don't know why they did this, gave SEBI the power. Ideally, the power should have been with the Reserve Bank of India, because these are unlisted companies. SEBI normally looks at listed securities. So SEBI now has a power to ban certain schemes which are called collective investment schemes and impose penalties. But SEBI is only going to act on schemes which are 100 crore plus. So below 100 crores, the scheme can stop taking money and then vanish as before. All right. A variety of schemes, as I said, over the course of the last few decades, a variety of schemes have come, raised money. It could be teak plantation, it could be land scheme, potato bonds, emu farms in Chennai, goat farms somewhere in Maharashtra. All of these things have raised money, and typically you get a certificate which looks like a proper bond, and they offer a return, like maximum return is double or 5 times or 12 times or even 50 times. As you can see over there, this is a potato bond in Calcutta, West Bengal somewhere, and called Flexi Potato Purchase Scheme. And these are all designed to entice people who look for a higher yield, and all come under fixed income and take money away from us. The common characteristics of all this is that they don't come under anybody's regulation. They are not regulated by SEBI, they were not regulated by insurance, they're not regulated by banks, they're not an NBFC, they don't come under any of these regulations. It's very easy to figure out what these schemes are. Are they regulated? Are they registered in any of the 4 financial regulators that we have in India, whether it's Reserve Bank, PFRDA, IRDA or SEBI? If they are not, then they will be one of these, and most certainly are going to offer you a higher yield and then eventually disappear. How to spot them? Very easy. Here are the 7 warning signs. This is a story from across the world, and the moment I point out these 7 warning signs, you will be able to very easily say, hey, yes, familiar, I know all about it. High guaranteed returns. Not only guaranteed, but high returns. Principal is safe, plus you're going to get a lot of money. Returns generated from a new business idea. Could be a numismatic coin, could be a disc which QNet was offering, or emu farms, something new. If it's an old thing you're familiar with, steel business can't give you that kind of return. You'll say, forget it, I'm not interested. But it has to be something new idea, emu firms. So it's fantastic. High agent commission. The guy who's selling it to you is incentivized. He's going to get a large chunk of your money. Rapid expansion. It's like everybody is talking about it. Lots of people are doing it. Who's behind it? You don't know. It's not Tata, Birla or any other people or multinational, anybody we know of. Lot of advertising and promotion. Speak Asia is a great example. But usually to reach a certain size of 100, 150 crore, you don't even need a lot of promotion. It's word of mouth. We are all very greedy. We put in money and we tell 10 people and the money starts flowing in very fast. But beyond a certain size, to get more and more suckers, you need a lot of advertising and promotion. In fact, Speak Asia was being promoted in IPL and at full page or half page advertisements in Times of India. And usually cash transactions. This is a little less today, but earlier cash transactions, you give us in cash, give you a receipt and no trail or whatever. I'll dwell upon a little bit on within the regulated schemes. I'll dwell a little bit on bank FD and company FD. A lot of people don't understand, or even if they understand, they forget the distinction when actually making the transaction. Now, term deposits, which is your fixed deposits for 11 months and 33 months and so on, with nationalized and large private banks, are completely safe. Okay, they earn low and taxable returns, but the principal is usually safe. I'm saying completely safe, not just usually safe. The reason is, in purely legalistic terms, if a bank goes bust, if tomorrow Canara Bank goes bust, you are likely to get only about 1 lakh under deposit protection scheme. But in practice, The Reserve Bank of India in the last 30-40 years has not allowed a single bank to go bust and depositors money not being returned. It hasn't happened. So for instance, Global Trust Bank was a private bank. RBI did not have direct responsibility. But when Global Trust Bank could not pay, or actually was bankrupt, it forced Oriental Bank of Commerce to buy Global Trust Banks. The depositors were safe, all right? So it's Oriental Bank and its shareholders took the hit. In the next few years, the profits were down. But the depositors of GTB were completely safe. I think we are still, and for many, many years, we'll continue to be in that situation where if it's a large scheduled bank, and I'm not saying this about cooperative banks. Cooperative banks is a different story. Reserve Bank does not take full responsibility of cooperative banks because they are under two different regulations. They are partly regulated by the RBI and partly regulated by the Registrar of Cooperative Societies. So RBI says if you give us full responsibility, then only we're going to protect the depositors the way we informally do for scheduled banks. But if it is a scheduled bank, it can be a small bank or a large bank, it can be a new private sector bank or a road public sector bank, doesn't matter, your money is 100% safe because RBI and Ministry of Finance will not allow bank depositors' money to go down. Company FDs are, as of now, even now, unsecured. Now, a few months from now, if I do this presentation, I may have to change this. The reason being, Companies Act of 2013. The Companies Act of 2013 has not made FDs secure the way bank FDs are, but has created such tremendous amount of responsibility on directors that they will think twice before raising money from the public and disappearing. For instance, now currently the Yash Birla Group is not able to pay fixed deposits. It may be a big group, part of the Birla Group, but it's not paying. And I don't see how they can pay because they're not earning enough, all right? They have too much of debts. If this is a situation under the new Companies Act, as in when the rules are noted, the Act is already notified, but the rules relating to all of these sections are not yet notified. When the rules are notified, it will be very, very difficult for a company, and the responsibility is placed on the directors directly. They can go to jail for deliberately withholding the money or knowingly not paying the depositor. So the responsibility levels have gone up. Earlier it was not so, and until the rules come, in fact, it is totally unsecured. So we keep getting mails from a lot of people, including senior citizens, saying I've invested in this, I've put money in FD in this company, and they're not paying me back. Can you do something? Isn't there any way of redress? There is nothing because they are unsecured. They are not secured against anything. This is the big difference between a bank FD and a corporate FD. Bank FD is fully secured, corporate FD is completely unsecured. And the difference sometimes when you are putting money in a corporate FD, if it's 1% more or 1.5% more than a bank FD, it is not enough, according to me, to justify moving from a bank deposit, moving from a bank and moving to a completely unsecured kind of situation where you invest money with a corporate. Now, usually the finance people will tell you that if the risk is higher, the return also should be higher. It is a fallacious statement. They said there's a big fallacy in this. This certainly does not mean if the risk is higher that the return ought to be higher. Nobody has given a God-gifted right to claim a higher return just because the risk is high. In fact, in real life, it's exactly the opposite is what we notice. If somebody is offering you, hearing this, somebody says, okay, I may be unsecured, but I'm compensating this with more than 4% return. Okay? Classic financial theory says that you compensate for the higher risk. So bank is fully safe, it's 9%. I'm unsafe, I'm giving you 13%. 4% more than bank FD or corporate FD is highly risky. The risk is not compensated, the risk has gone up because no company willingly is going to give you 3%, 4% more from what a bank is giving you unless the business itself is suspect. Unless the business is so shaky that he's not been able to make a share issue, he's not been able to make a debenture issue, he's not been able to borrow from the bank at a lower rate, and he has come to you with an unsecured deposit offer. And he has to pay you 14% because he has no other means of raising that money. So higher the return, higher the risk. Higher the risk, just because you've taken a higher risk doesn't mean you're entitled to higher return. In this case, it's exactly the opposite. The risk has just gone up tremendously because somebody has offered you a higher return. So in fact, rather than feeling good and going for it, the red flag should go up, saying that how the hell is he going to pay me this kind of a return, and why isn't he getting money from anywhere else? That's simple as that. Now, it's good to step back and take a look at the returns that different asset classes provide. And this is usually a section that I do, and I'll just have one slide in this particular section, just to make you aware of where fixed deposit stands in relation to variety of asset classes. If you put in money in insurance, for instance, if you put your money in bonds or in equities, in other than fixed income, what kind of returns are you likely to get? And what is the return in that entire spectrum of assets where we can invest in? What is the return for fixed income? This is what happens in real life. Doesn't matter what anybody says theoretically. Now, the fact is that the Sensex has gone up 14% in the last 20 years on a point-to-point basis. Depends on how you choose your start date and your end date. If you just do a 20-year flat kind of a period, start and end, it's a 14%. It is not likely to be 14% for every 20-year period. In some 20-year periods it will be more, in some 20-year period it will be less. But typically equities do provide little higher return than fixed income. That is the reason why the whole reason why they are able to do that, because when we say Sensex, we are talking about 30 outstanding companies, they are well run and so on. So I won't get into that, but the fact is that if you invest in equities in the 30 top stocks in this country, you are likely to get about 12%, 11%, 14% in this particular range. When interest rates shoot up, if the government is not able to control inflation, as happened in the mid-90s, when Rangarajan was the RBI governor and someone called Dr. Manmohan Singh was the finance minister, when inflation shot up, banks have to pay you more. The interest rate goes up. Typically the cycle goes like this. Interest rate goes up, and therefore the government, which is a biggest borrower in the market and is constantly borrowing through the Reserve Bank of India, has to come to the market and borrow at a higher price. So the next government bond auction that the government does through the Reserve Bank of India will be at a higher price. If the inflation goes up higher, the following auction will be higher. This is how the interest rates go up. If the government itself is borrowing at 10% or 11%, let's say, then the banks also have to raise their interest rate to attract money from you and me, which means across the spectrum, across the range of fixed income products, interest rates keep going up because the biggest borrower, the government, is borrowing at a higher and higher rate. Until a situation where the inflation starts falling and the interest rates start falling, then the opposite cycle happens. In the mid-90s, in 96, 97, when inflation was double digits, 12% and higher, bank FDs, 1 year bank FDs had gone up 12%. It hasn't gone up beyond that, right? So that is the maximum you're likely to get. And when the opposite cycle happened, which means that the interest rate went up, inflation went up, nobody could borrow anymore, people couldn't survive based on such high borrowings, companies started closing down, demand for money was less, interest rates started falling, deflation, or rather less of inflation, started happening. It fell all the way down to in 2004-05, the inflation was really low because there's no demand for money. The industrial production was really low. And all of these yojanas and all the infrastructure projects, etc., had not started at that time, not in such a massive scale. The bank FD rates were down to 5%. All right. Now, typically, you would, just to move away from this for a second, in 96, around 96, 97, the Sensex was around 4,000 or so. When the interest rates were so high, inflation was so high, companies were not able to not able to perform properly. By the time in 2003, when the inflation had fallen all the way down, the Sensex was around 2,900, 3,000, which means the equity market works exactly the opposite way the bond market. When inflation is high, that is not the time to buy stocks. When inflation is low, interest rates is low, that is the time to buy stocks. For bonds, it's exactly the opposite. If banks give you 12%, that unsecured company which desperately needs money and has nowhere to go has to give you another 3%, 4% more to attract money from you. Which is why in some of the companies in the 2000, like a Modern Mills or whatever, I think they've gone bankrupt, they were all offering 18%, 19% and so on, IDBI, deep discount bonds, all of these things had come at that time. And private companies were borrowing at really exceedingly high rates, almost at 20% or so. Similarly, when interest rates started falling all the way, bank FDs became 5%, the companies could borrow at a much, and this is the reason why stock markets goes up when interest rates go down so much, because you borrow at 8%, you're very comfortable. You can invest, you can expand, your profits go up, and so on and so on. In 96 onwards, insurance sector was privatized, and a lot of insurance companies launched what is called unit-linked insurance products, which essentially meant they took money from you, put some of the money in bonds, but a lot of money went into the equity market. After tax, after cost, after all the advertisement that they do to make you buy ULIPs, the returns are quite pathetic. It's about 6 to 8%, right? And if you put your money in money back and all of those kinds of the older traditional insurance plans, it's even less. It's about 4 to 7%. Now, this gives you a range of returns that you're likely to get. And as you would notice, the reason why people do not move out of fixed income is because if you see the range of the returns that are possible, a 9% return from bank may be taxable, but for a secure product, for no scope for loss of principal, it's not bad at all. It's a pretty good return, right? And this is the reason why people stick to bank FDs. But of course, we now have more choices. Earlier, it used to be only bank FD, and now we now have inflation index bonds, and we have tax-free bonds, and a variety of other options to move out. That was about returns. I'll tell you a little the risk that are there in the various financial products, but I'll tell you from a completely new and a different angle, right? Normally, people look at risk relating to a particular product area. What is the risk of investing in equity, or what is the risk of investing in bond or insurance, and so on and so forth. That's one way of looking at the risk. But you can also classify risk in these manners, and this helps us to very clearly see that fixed income should only be limited to 1 and 2. Fixed income coming under 3 or 4 is not really fixed income. It's so risky that it loses the character of fixed income the way you want or the way you understand. How? Super safe. If you have cash or if you have government bonds held to maturity, nothing can happen to your principal. That is fixed, right? Take number 2, some formal structure of guarantee like a bank FD, okay, or any other bond held to maturity like a quasi public sector or even a corporate bond. Fiscal bond held to maturity, the company is going to. There is a formal structure, which means there is something happens to the company, you have some rights. At least there is some safety. Moment we move out of these two categories, we have a lot of fixed income type of products. Just because they have a coupon or they have an interest or that you get regular income doesn't mean that they have the same fixed income character that you are looking for, which is safety or principal. Traded bonds, bond funds, these two among all this are also passed as fixed income. Debt mutual funds, for instance. Now you can call it bond funds, you can call it debt mutual funds, and so on. They do not guarantee anything. The reason they cannot guarantee anything is because they go and invest in a product in the market. The market prices of those products fluctuate. So depending when you buy, you may actually incur a loss in your principal. So if you buy a bond fund at a time when interest rates are low, and then the interest rates start rising, maybe even 2 percentage points, the value of your bond fund is going to go down by 20-30%. That is going to be a loss for you. Why? Because they are market linked. Please try to understand the significance of a market linked fixed income product. That is not something which we should ever buy unless we are skilled at market timing. If you keep your eyes open and you've trained yourself that this is the time to buy a bond, because bond prices are going to go up, like stock prices go up in certain situations, then only you should buy a fixed income product with an underlying market linkage. Otherwise, it is a market linked product exactly like stocks. They go up and down. Unlike your bank FD, where the principal does not go up and down. The distinction should be very, very clear. And then, of course, the speculative fixed income products that I described earlier with all kinds of shady bonds that have come to the market. Now, one of the pitfalls of going for this peace of mind, safety, and the principle is utterly, completely safe, is of course the hidden killer thing called inflation, right? Now, please remember, at no time, virtually at no time, will you be able to beat inflation by investing substantial part of your money in a fixed income product. That does not mean that the fixed income product should have no place. It has its place, and I'll explain that later in the entire area that I talked about, which is asset allocation. But when you're putting money in bank FD, you must remember that the rate of interest of bank FD, almost in 90% of the cases, will be below the inflation rate. The actual inflation rate for urban people, not the inflation rate what the government used to tell us. Of course, now they have CPI urban, Consumer Price Index urban, which is almost 10%. Now it's gone down to 9.73, but it was double digits. All these years the government did not admit to a 10% inflation. Now, I've not even gone to 10% inflation. I've gone to 9 and 7% inflation, and how our value of our money erodes, right? So for instance, this is a 30-year period acting on, let's say, 1 crore of rupees at 7% and at 9%. What does it mean? If I give you 1 crore 30 years later, if I promise to give you 1 crore 30 years later, what is it that you would be able to buy with that? What would be the value of that 30 years later? At a 9% inflation, the value would be 4 lakhs. To put it differently, suppose a bypass operation costs 1 lakh. And I promise that 30 years later, when you need a bypass operation, I'll give you 1 lakh rupees. 30 years later, I give you 1 lakh rupees, you will get 4,000 rupees out of that. The bypass operation will not happen, right? Now, the longer the period, the more difficult it is for human mind to understand how dramatically the value of money goes down. If it's a shorter period, it doesn't matter. 1 year, 2 years, 3 years doesn't matter. But the fall is dramatic and steep as you go further and further and further. And anybody who does not understand this and invests only in fixed income without understanding this is going to make a cardinal mistake. Now imagine a situation where a substantial part of your money is absolutely safe in bank FD and you are in a taxable bracket. Imagine somebody working in the IT sector with no knowledge or interest in finance, and none of them have knowledge or interest in finance. We know many of them. They have interest in 2 things: coding and cricket, and 3 things: coding, cricket, and cinema. So 3 C's is what occupies them. So what they do, I mean, they have some amount of money going into their EMI, going into their home loans, to pay their home loans, which is another problem, but that's for a different time. Large part of the money, unconsciously, without any planning, without any thought process, is lying in the bank. And then the bank relationship manager, if he's nice, he can tell you move it to FD. If he's not so nice, he'll say buy this insurance, and that money is gone down. Assuming that the money is in FD, safe. He's earning low returns. Why? Because he's in a fully taxable kind of a situation. So on a 9%, he pays 30% tax. His return is 6.75%, 6.7%. His inflation is 10%. So 6.7 and 10% every year, the value of his savings is eroding to the extent of 2.7% year after year after year. So low returns plus high inflation, it leads him to a situation he wanted to escape, which is capital loss. He didn't want to buy equity mutual funds. He didn't want to buy stocks. He didn't want to take any risk. And yet, the inflation has brought a certain risk into his portfolio, which is disastrous. Now, why I said 30 years and why am I emphasizing all this long periods of time? Because thanks to advancement in healthcare and medicine and medical sciences, people are living longer and longer and longer. So the same gentleman, at the age of 58 or 60 or whatever, he'll retire. If he's highly skilled, he might be able to continue to earn, which is a boon. If he is in the government, now those who are retiring, they are in really the golden era of any time, because they have an inflation indexed pension, which is absolute. I mean, in terms of real value of money, post-retirement, they earn crores of rupees if you really add up all of that. But most of us are not. Even those who are entering the government workforce now, their money will go into new pension system, and they're not going to earn the inflation index pension. So somebody from the private sector, he will live for another 25 years. Another 20 to 25 years he'll live very easily. Most of, look around, hardly anybody, and people are getting more health conscious, right? So on the one hand, the healthcare quality is increasing and people are getting health conscious. So he retires and all his money is in FD, and now he has no income. His only income is from that, and that money has not grown. Whereas costs have relentlessly grown, not only over the past 30 years, but are going to grow at an even greater pace over the next 25 years. So for almost 30, 40 years of his life, he is really hit hard by inflation. And unless he has that much more wealth, so it does not matter. If he has 20 crore in the bank, then of course it doesn't matter. But if he doesn't have that kind of wealth, he's surely going to be in deep trouble. So that's the downside of fixed income, right? A lot of people invest, as I said, in fixed maturity plan, debt funds, debt mutual funds, income fund, MIP, capital protection funds. All of these are not, there's no guarantee. If there is no guarantee from somebody who is actually taking your money, which is either a bank or a mutual fund company or whatever, then it's of a different category. It's category 3, which means it can go up and down. Now, who would have known? You put money in fixed maturity plan, it could be Birla, could be Reliance, could be HDFC, doesn't matter. Somebody is giving 9.8, somebody is giving 6.69. And we want 0.25% more. Is the difference 0.25%? The difference is a 3%. 1 year FMP. Only in 1 year. It's not that it's a 20-year product. People have made a mistake in assessing interest rate risk. Nothing. Within 1 year, there is this difference. And there's a Birla here, there's a Birla there also. There's a HDFC there. In your next year, if you do, or if you change your dates another 6 months, that HDFC will come here. Same HDFC, FMP. The reason is that these are market-linked products, or they make assessment about interest rates which are not correct. And over a shorter period of time, in a market-linked product, this is bound to happen. So when you buy FMP, please remember, it's not guaranteed. Even the return is not guaranteed in some cases. In this case, the principal is guaranteed. Nothing major happens unless there is even then, in 2008, even FMP principal, people were not being able to pay. Lotus Mutual Fund could not pay the money it had raised from FMP. The SEBI chairman called a mutual fund, and because of this tremendous impact it is going to create in the minds of depositors and investors and so on, so it forced a mutual fund, say you buy all the Lotus mutual fund, take it into your books and pay. But it was because a chairman of SEBI stepped up and put a pressure and did this. It was not his job to do it. If Lotus mutual fund couldn't pay an unsecured product in any other part of the world, they would have gone down. That's it. So in an extreme situation, even the principal could be at risk in case of FMP. But principal, to repeat, in 2008, nobody's bank deposit was at risk. Nothing happened. There was a global financial crisis. Nobody can say that the ex-bank, when I tried to withdraw my FD, said, sorry, I can't pay you. Bond funds, worse than FMP. FMP because they're locked in and a similar kind of products, so they are somewhat similar. This is 1 year return of bond schemes. Why is it that somebody is giving 10% and somebody is giving 2%? Because they take your money and invest in a market linked product. The product that they invested in at a time they invested in was wrong. So they made lower returns. In 1 year, 2% in a bond scheme. This is why we say, if you know when to invest in a bond scheme, which is when the interest rates are low and you can sort of assess an interest rate cycle, then by all means invest in a bond scheme. Other than that, this is what is likely to happen. After a year, if this is what you see, what are you likely to do? You are not likely to ever wait. As an investor, you will say, what is this? Am I getting only? This has lost money. The last one, Sundaram Flexible. That's not JM or any other Faltu fund. Sundaram. They are one of the largest NBFCs. They know fixed income better than anybody else. They have been raising public deposits for decades and decades. They made a mistake in assessing where to put the money. And therefore, it led to an actual capital loss in this case. So fixed does not mean guaranteed because these are all part of category 3, market linked. Now, as I mentioned, the key is to be able to buy the correct ones, and buy as much as it is right for your profile. We need to mix the two. We need to mix a little bit of something that is safe and then something that is risky. We divide people according to a certain age group. This is by no means this is absolutely completely scientific, but roughly we felt that this is something that could work. If you are younger, you have that much more time and you are earning regularly. You don't have the compulsion to invest a large amount of money because you don't have that much of money. In the early part of your career, you are earning less. Moment you're in the 30s, you have obligation. You may be earning more, but you've married, you've got a kid, and you've got a home loan, you started having obligations. So in any case, your savings may not be that much. You are able to take a long-term view and you're investing small amount of money. For these people, we suggest to put the power of compounding to the fullest impact and have a small amount of money invested in fixed income and larger part of the money invested in equity mutual funds. And this money, where should it go? The bulk of it, I have a little section right in the end now how much to subdivide this, which I'll explain later on. But if you're young, the lesson in this, if you're young, the bulk of your money has to be regularly invested in equity mutual funds, right? Now, if you do that on a conservative estimate of only about 10% per annum on a blended basis, which means what you get out of 85% plus what you get out of your 15%. Forget 85, what you get out of 70%, which you invest in equity mutual fund, assume just about 11% compounded, which is tax-free, which is a big advantage, and the rest 30% from bank FD, you're going to have a lot of money if you are able to invest quite regularly. The next age group have to face rising household expenses. As I mentioned, you need to plan for your children's education, pay down various kinds of loans, and also plan for your retirement, which remains a pretty low priority for people at this stage, but they should. Nobody wants to hear what they should be doing, but they should. Now, this is still a time to invest a substantial part of your money in equity mutual funds. As you would notice, I've given a range, and the range has only gone up a little bit for fixed income at this stage because the time period is less. If you're closer to 45, you have 15 years. 15 years is a long enough time for you to be investing 65% of your money in equity mutual funds. And if you do that at 25,000 on a 10% basis, you're going to have a tidy sum of about 4.5 crores by the time you are 60. 46 to 60, household expenses are lower. Kids have sort of married and possibly settled. Expenses of dependence, if any, is going to be a major issue. Always, this is a big issue. If you have dependents, the whole picture changes. The moment you have dependents, you can't take risk. You necessarily have to invest much more in fixed income. Loans usually get repaid by that time. You have to keep investing for your retirement. Near 60, you have to do systematic withdrawal of wealth if invested in equity mutual fund. This is not the ambit. Two of us have to speak on fixed income. Maybe we'll do a separate session on systematic withdrawal of fund. We have a formula for that. But at that stage, if you are able to invest 25% of your income in savings, you will probably invest in this manner. The reason that we go against the conventional idea of investing a large amount of money still when at the age of 46 to 60 is because all investment plans usually conceptually are borrowed from the West, and we don't think for ourselves. If you think for ourselves, you will know that at a certain age, 60, 65, you have to write a will, and you will necessarily want somebody to have your wealth. It's very rarely that we say we don't want to leave it to anybody. Even if we don't have kids, we possibly leave it to charity. And the point that I keep repeatedly making is that if your money has a life beyond you, if you're not destroying everything and going away, even if you were to donate, forget about leaving for your kids, that money, that savings that you built up, the investment that you built up has got another life, maybe 50 years life, which is why I say keep investing so much of money in equity mutual funds. Maybe up to 85 you get a big bang for your buck. Even if not, you leave it for somebody. For them, this has got a tremendous value. Post-retirement, what is the role of fixed income after you retire? We usually, we've done a lot of analysis of this literature. The least amount of research or information or advice available is what happens post-retirement. How much to withdraw, at what rate, where to invest your money, because the reason for such low amount of research and information available is that because the time period is very little, number one, and number two, nobody can make an assessment how long you need the money. Because of these two major uncertainties, there is very little research available. People don't want to stick their neck out and suggest something which will probably go right in one case and may go wrong for another case. We think that a step towards that is to create a two-part portfolio. So the fixed income part, which is about 60%, will give you a steady income. Where you would invest, I'll go down. I have, as I said, a slide right in the end, within fixed income where to invest. But if you have 60% of your portfolio at retirement, you're going to likely to get a regular income. It could be from bank FD, could be from tax-free bond, could be from annuity, and so on. And the rest, 40%, should be in a growth portfolio, which would be useful for you to beat inflation. Remember, this is already grown if you have invested prudently from your mid-30s onwards, or even in your mid-40s onwards. It already would have grown significantly, and this is the money that you can use to beat inflation. If at all there is an emergency, withdraw the principal from the fixed part, but not from the growth part. Time your withdrawal from the growth part. There are ways of timing. There are various people who explain how to time your equity withdrawal. We ourselves have done seminars on how to time your equity withdrawal in your post-retirement period. What should you be expecting from a good equity mutual fund? About 10 to 12% tax free. I've already mentioned this. From FD, 8.5% taxed. But usually at that stage, you may not have an income that is taxable. and therefore you're getting a good enough 8.5% post-tax as well. What should you be expecting from a good quality corporate FD? Around 10%. As I said, anything more than 11%, red flag. The company has no other means to borrow, it's borrowing from you. You shouldn't be giving them your money. Corporate bonds, they are going to get more and more popular. They already are very good quality corporate bonds. For instance, there's a bond of Tisco or Tata Power. Both of them have perpetual bonds. The coupon is about 10.5%, 11%, which is a fabulous rate of return. These are perpetual bonds, which means they're like equity. They're never going to be extinguished, but they don't grow like equity. You get a fixed income. If you want to sell, the way you buy, the same way you can sell, which is through a stockbroker. Now, I also mentioned, I've mentioned it various times earlier, that how to allocate within the fixed income portfolio. I have repeatedly said guarantee of principal is very, very paramount. Nothing should jeopardize your guarantee of principal in search for a higher yield. So bank FDs must get 70% of your money. Corporate FDs 15% if they are good quality corporate FDs. Corporate bonds another 15%. This is not for trading, only for bonds that you hold till maturity, or you're comfortable able to sell at a par value when you need the money. Liquid funds can form a part of your portfolio. They're slightly better than savings account. You're likely to get about 7% tax free from a good quality liquid fund, as opposed to 4% taxable from a bank savings account. Over the course of last 1 year, one and a half years, earlier there was infrastructure bonds, and now we have tax-free bonds from various government companies. NHP, NHAI, IRFC, all of them are coming out with tax-free bonds. Raj is going to, he's done a cover stories on this, he's an expert on that, he's going to explain in detail. But if you are in a taxable bracket, this is an absolute must. Opportunity was not there earlier. You were likely to get 8.6, 8.7% tax-free. Large part of your money has to be on this. In fact, I would say now that we have tax-free bonds, if you are in tax bracket, you should have 70% in FD and 30% in tax-free bond. Don't even bother about corporate bonds and corporate FDs, because they are both taxed. If you're not in a tax bracket, or if you're up to 10% a taxpayer, then of course you don't need this. You're quite fine with corporate FDs and corporate bonds as well. That was my part of the presentation. Thank you very much.